Bags. Hey gang, I'm Dr. Who. This is Accounting is a Joke, where accounting makes sense so you can make dollars. Today we're going to take a look at a walkthrough problem of how to properly record utilizing the allowance method, particularly percentage of receivables. So if you're unfamiliar to the percentage of receivables or the allowance method, don't fret gang, I dropped a link to get you up to speed in no time. So with that being said, let's get it. So it tells us on January 1st, Hilltop Flagpoles had accounts receivable of $28,000 and allowance of bad debt, had a credit balance of $3,000. During the year, we had the following transactions. All right, we had a couple of transactions, not too bad. And the requirements tell us to journalize Hilltops during January, use the allowance method. They want us to post some stuff to the T accounts. They want us to make an estimate based on 10% of receivables, then post that to the T accounts, and then they want to know how it's going to look on the balance sheet. Easy breezy, gang, because accounting is a joke, and I'm here to teach you the punchline.
And all you can talk about is money.
Anyway, we're dealing with accounts receivables, and we know that when we deal with accounts receivables, something we have to mention is how to account for uncollectibility, i.e. not receiving cash from our customers. So we have two ways to account for that: the direct write-off method and the allowance method. This particular problem supports the allowance method, which means that we're going to estimate based on a certain percentage of our accounts receivable the bad debt expense at the particular period. We will also create an allowance for uncollectible account, i.e. allowance for bad debt account that happens to be a contra account to accounts receivable. That contra account to accounts receivable will be reported on the balance sheet to help report the net realizable value of our accounts receivable. Net realizable value is simply taking the gross amount of accounts receivable minus the allowance for bad debt. So with all that said, let's attack this problem. First, they want us to journalize the transaction that took place on January. So we had some sales of $185, $164 of it was on account, and $21,000 was in cash. But they want us to ignore the cost of goods sold. Okay, so we made a sale. Let's record that. Well, first, we need to record the credit sales portion of it. So we're going to debit accounts receivable for the $164. Then we have to recognize the cash that we received for the $21,000, which is a debit, thus causing us to credit sales revenue for the total amount, which happens to be $185, gang. And this is to record sales for the year. We're going to check the answer. Excellent job. Next, it tells us to record the collections on account for $135,000. Okay, we know how to do that, gang. We're going to debit cash and credit accounts receivable for that amount. We're going to check our answer. Well done. Now they want us to perform a write-off for the uncollectible receivables of $2,300. Gang, we're doing the allowance method, so anytime the company writes off under the allowance method, we are going to remove a portion of that accounts receivable that wasn't collectible, as well as the allowance for bad debt, the contra account. Therefore, we must always debit the allowance for bad debt and credit the accounts receivable for the $2,300. We're going to check our answer. Beautiful work. And now they want us to simply post those transactions that we previously just recorded in the journal. So I'm going to go ahead and get to that. But don't forget the information given in the initial description, gang. We started out in January with accounts receivables of $28,000 and our allowance for bad debt credit balance began with $3,000. So I'm going to post these. So in summation, we started out with $28,000 in our accounts receivable. We had a credit sales that increased by $164,000, followed by a collection for $135,000, and a write-off for $2,300, which gave us an unadjusted balance of $54,700. Likewise, our allowance for bad debt started out with a $3,000 credit balance, but we wrote off $2,300 on the debit side, which gives us an ending balance, unadjusted of course, of $700. We're going to check that answer. Fantastic. So now it tells us that Hilltop's adjustment to record bad debt expense, assuming we have an estimate of bad debt as 10% of accounts receivable on January 31st, 2024. All right, gang. So now we're about to make the proper estimate. But before we make the proper estimate, we must realize that there are two ways we can do so, either the percentage of sales method or the percentage of receivables method. And based on this description, it enforces that we utilize the percentage of receivables. So rule number one about percentage of receivables is you have to multiply the estimated percentage of uncollectible times the ending balance of accounts receivable. And rule number two is whatever that amount is you calculate must become your new ending balance for your allowance for bad debt. Therefore, we're going to take that 10% of estimated bad debt and we're going to multiply it times our ending balance of accounts receivable, which happens to be $54,700. That gives us a total amount of $5,470 gain. That new calculated amount must become our allowance for bad debt. And since we already had $700 on the credit side for our allowance for bad debt, we must make the proper adjustment by subtracting the two, which will give us an adjusted amount of $4,770. Therefore, we're going to make our estimate by debiting bad debt expense and crediting allowance for bad debts for the $4,770. We're going to check our answer, bags all day. And now they want us to make the proper adjustments by posting to our ledgers. So in summation, nothing affected our accounts receivable per the estimate amount. Therefore, we're going to carry over that $54,700 as a debit balance for accounts receivable. We just recently made an estimated adjusted entry of $4,770. Therefore, our allowance for bad debt increased by that amount, which gives us a new ending balance of $54,770. Remember, gang, that was our initial calculation from the previous 10% of accounts receivable. And lastly, because of our estimate, we have to increase our bad debt expense for the period by a debit to bad debt expense of $4,770. And lastly, due to the proper estimate of $4,770, we must increase our bad debt expense, which will give us an ending balance of that amount. We're going to check that answer. Well done, gang. And finally, we need to summarize how this particular accounts receivable must be reported on the balance sheet. And as previously stated, whenever we're practicing the allowance method, accounts receivable will always be reported at the net realizable value, which simply means that our gross amount of accounts receivable must be subtracted by our allowance for bad debt. And basically, gang, that is just letting the viewers of our balance sheet know how much we truly expect to collect on these accounts receivable. Therefore, we're going to report our gross amount of accounts receivable, which happens to be $54,700, and we're going to subtract our allowance for bad debt ending balance of $5,470, which will give us a net realizable value of $49,230, gang. We're going to check our answer. Excellent job. So there you have it, gang. A very thorough illustration of how to properly utilize the allowance method by estimating based upon your percentage of receivables. So if that light bulb clicked, which I know it did, do me a favor, hit the like button, hit the subscribe button, and share the channel with your friends. Don't be stingy, gang. As always, I'm Dr. Who, and it's my humble pleasure to have you guys share your time and energy with me, and I will see you soon. Bags!